The goal of GCA, of Greenwood Capital Advisors, it's in the tagline, built for founders forged on Wall Street. We're building this thing to provide founders with Wall Street level sophistication, the folks who really need it, who actually have challenges that they're trying to overcome beyond just pricing issues, helping them to refine their businesses in a sophisticated way, which is why we've built out the service offerings the way we have, right? But the continuum of services from the basis of build to bank through transaction access. So build to bank, the genesis of it is really in our DNA, in GCA's DNA. What I noticed was a lot of CFO services that are currently in market have no defined purpose. They tend just to kind of sit in a seat and provide a service for sometimes indefinitely. Build a Bank was really created to combine that need, but really integrate it into a transaction oriented system. So having a defined goal in mind, which is to make a company or client institutionally ready for capital. In order to make a company ready for institutional capital, it requires alignment between their business operations and their finance function, which is really what a CFO is supposed to do. Even though there's an end goal in mind, which is making these companies institutionally ready, as a byproduct of that, you have to provide excellent CFO services to do that. So it's really taking CFO services, combining it with my DNA as an investment banker to help my clients align their finance function with their business operations. So the first thing we do in any scenario where we're trying to analyze or trying to raise capital for them is to determine what is the optimal capital structure, how much debt they should have, how much equity they should have, but also looking at their current capital structure and what they currently have. So what we do is we model out their expected growth, what they're likely to look like once at stabilization, when they're stabilized, and then figure out the optimal capital structure at that point, and then back into what is available for them when I get engaged. It's looking at where they need to be long term, figuring out where they're at today. If the capital is to if they need to get out of that capital, what's the most efficient way to get them out of that capital into something that is more strategically aligned with their long term goals? It really starts with treasury and capitalization and optimal capital structure analysis. I created dual track before I created build to bank as a precursor to executing a transaction. The idea being that we'd be doing CFO services to optimize the business concurrent with building out what's required to go to market. So whether it's a sell side M&A a trade, or whether it's raising capital, the point is that there actually is we're built a bank, we're working towards a hypothetical transaction. Dual track is we actually want to be in market and close within a specific period of time. However, either their key performance indicators are off, there's some sort of disconnect between where the most successful people in their market are trading at and where my client would likely trade based upon their financial strain, something internal that needs to be fixed so that then we can present them in the strongest light possible. So the idea is that we come in earlier. This typically has a 6 to 12 month or maybe longer pre-marketing phase, meant to tighten those KPIs, to increase valuation, so to show a longer period of success in the context of how the market defines success for that type of client or person in that market. That's what we call dual track, because we're running these things concurrently. We're getting their KPIs together as we're prepping them for the market. We're running these processes concurrently. If I'm going up to someone, I'm usually going to say, okay, the market's trading somewhere between 5 and 8 times, or maybe 8 to 11 times. There's usually a 3 point differential between the bottom of the market and the top of the market. When you're looking at multiples of EBITDA, right? Particularly when we're talking about millions of dollars, that's a gigantic difference. And why a company trades at 5x versus 8x has a lot to do with that performance. It's also how they track that performance. It's whether or not they are tracking the right KPIs. Because maybe if there is a difference in terms of if there's a difference in terms of performance between where they're at today and that person at the top of the market, right? It's best to fix those things before you go to market. A $1 million company and it's selling for 5 times or 8 times, what, $8 million is a lot more than $5 million. So by spending an extra 6 to 12 months refining KPIs, looking at market data to determine why those 8x companies sold for that multiple, we can then reverse engineer that into my client to then achieve that top of the market result. So the genesis of everything else really started with gaps in the marketplace that I found, or gaps in the process within a full service investment banking context. This is what people typically, the full service investment banking product or service is what the market's used to. What kills transactions, or really what reduces value, typically are surprises or things misaligned, or facts or dynamics misaligned with expectations, with market expectations. What I found with a lot of, and it's a great, but when those things don't exist, the investment banking process is tried and true. You go in, you figure out what makes the company valuable. You figure out, okay, where do similar companies trade in market? How does our company compare to those companies that traded in the market, right? Which then informs what informs my client's expectations, or my expectations to the client, as far as where they're likely to come out at, and then we just execute. What I found in the middle market was that a lot of clients, particularly in the lower middle market, may have some gaps that have a negative impact on valuation. And therefore, they may need to start at either dual track or build to bank. Full service investment banking, there's nothing novel about it, in the sense that it's there's nothing unique in terms of how we approach it. I just leverage my background, my almost 20 years of experience, to execute these things effectively. But it has to be for the right client that's well prepared, where the gaps are understood and where the expectations are aligned. Transaction access is pure distribution. That's really what it boils down to. Full service investment banking, dual track, build to bank. Phase one is presupposed, right? We're working through phase one, is what I call working with clients to get them prepared for a transaction, or whatever it may, this, I call it phase one. Phase two is the actual market transaction. Transaction access is pure phase two, pure distribution. They're sophisticated. They don't need me to model. They really don't need me to put together intense marketing materials. It's just me making phone calls, getting them access to my network of investors, my network of capital, or buyers, whatever it may be. It's the capstone to the continuum of services, from least ready to be in market to 100% ready to be in market. Transaction access is that 100% ready to be in market scenario.